I'm going to hit broadcast, and then I'm going to do the share with Facebook as well. Hey everyone, we'll be starting momentarily. Please stand by. We'll be starting the webinar momentarily. All right, let's get started with our webinar. Hello, everyone. This is Anita Campbell. I'm the founder and CEO of Small Business Trends, and I'm joining you from a hotel room in Austin, which is why I've got my phone, because the connection isn't necessarily the best without the phone. So please ignore the phone at my ear as we get started here. I'm also joined by our panelist today, Rohot Arora, the co-founder and CEO of Biz2Credit. Hey, Rohit.
Yeah, thanks, Anita, for the invitation.
Well, thank you so much. So we are here to present a credit clinic of sorts. We're going to be talking about how to fix your small business credit and what steps you can take to be in charge. So as you can see from the screen, that's our backgrounds there. I write a lot about small business matters and talk and discuss small business things. And I've been publishing Small Business Trends for 14 years now. Rohit, tell us a little bit about you and how you got involved in Biz2Credit.
Yeah, so I'm the co-founder and CEO of Biz2Credit. Me and my brother, we started the company here in New York in 2007-2008 period, so it's almost 9-10 years now. And we have seen the worst of the credit crisis, and now we are seeing the time when the economy has improved and there's more access to credit. So over the years, what we have tried to do is that we have tried to educate the small business owners about the credit. We have tried to then help them to navigate the whole process, and then also we help them to execute on it. So while typically there are some players who will just help them in discovering the best options, we are not only doing that, but we are also funding those options. So we are funding them through a large variety of sources, banks, non-banks, but every piece of funding is taken care by Biz2Credit. So the benefit of that is that as a customer, you never leave us, and we never leave you, actually.
Very good, very good. Next slide, please. So what we're going to do today is we're going to take a walk inside the mind of a lender. Now, this may seem a little strange, but the idea here is to help you understand how a lender looks at a small business so that you know just exactly how it is that you can go and satisfy that lender and give the lender what the lender is looking for, have the best chance possible for a business loan. Next slide. So Rohit, everyone wants to know, why are small business loans denied? And I see we've got 3 reasons here. I understand these top 3 reasons are reasons that come from Biz2Credit data. Is that correct?
Yes, absolutely. So I think there's a lot of mystery behind small business loans, because a lot of times the business owners will say that, they have a good business, or they have, they're trying to, work very hard and trying to get some access to credit, and why are they not able to get it? And these are the top three reasons we see. Where you could, a lot of times business owners don't pay a lot of attention on their personal credit. They borrow a lot of money to start a business, and then they, get into a debt trap. A lot of time, they are in industries which are traditionally considered to be more high-risk industries. So industries like retail traditionally have been considered more high-risk by banks. Now with the electronic payments coming in and more of the credit card usage, there are new products which are available. And I think the third big reason is, obviously, if your sales are pretty low, then, nobody wants to lend you the money. So I think these are the three big reasons, we see on a daily basis for people not able to access or to get access to credit.
So I know we're going to talk about the personal credit scores in just a minute, but I want to ask you, could you give us an example of what would be a high-risk industry? Like, have you seen any particular industry that lenders say, ooh, I don't want to get involved in that industry? Or maybe they get involved, but the terms are very stringent. Give us an example?
So traditionally, most of the banks don't want to get involved with restaurants. They don't want to get involved with any of the retail establishments because in their view, most of the restaurants don't own the real estate. And especially if they're non-franchisee, then it's very difficult for them to, predict how the performance of that restaurant would be. And other stuff is like retail establishment, bodegas and delis and small, stores, because again, their problem is that, it's all pretty much a cash business, multitude of transactions, but low value transactions. And there are no long-term assets in those businesses. So any of those businesses where either there are no long-term assets, lack of a big brand, if it is a non-franchise business, lack of real estate or any other hard collateral, makes them more risky for the banks, the traditional banks and the traditional lending institutions. And that's where, a lot of these businesses, have a problem to get access to credit. Because, in this country, we have so many mom and pop shops, which are doing, business in every corner, every nook and corner of the country. And they have significant, business volume in an aggregate manner. But, trying to get access in traditional format is still very tough for them.
Okay. Well, and thank you for that. And it doesn't mean that it's impossible to get credit. It just means it's going to be harder if you're in one of those industries. Got it.
Yes, absolutely. Yep.
Okay. Well, now we're looking at a screen that talks about why personal credit and business credit matter in a small business. So walk us through, why does a lender insist that the business owner sign or guarantee the loan? What's going on with that?
See, typically in a small business, the business owner is the kingpin of the overall health of the business. So if the business owner is not motivated enough to work, or business owner has some other problems, or they are not paying enough attention, the business will always go south, because it's not like there is a large number of people who can manage it. It's not like they have, these, revenue streams which are independent of the fact whether the business owner spends any time or not. So I think it's a very person-driven kind of businesses, most of the small businesses. And that's where, most of the lenders want a personal guarantee. The other big reason why the lenders are looking for personal guarantee is because a large majority of small businesses in America are sole props. So most of the income actually flows into the personal accounts or the personal obligations for the business owners. So typically, once you are a sole prop, there's no way for you to segregate between business and personal. So that's where personal guarantees become even more important, because if it is a separate corporation and you have a like you have your account receivables and all that, they still, you can get account receivable based financing, which can come without a personal guarantee. But traditionally, most of the businesses are not organized like that in US. So that's one big reason. The second big reason is that, what it has shown, the data has shown that wherever business owners personally guarantee the financing, it is actually lot better from a performance perspective. We have seen that, then business owners are more responsible, more cognizant about their duties of paying back, and they also are more hesitant to go and declare bankruptcies, because it's going to impact both their personal credit and business credit. So I think from a lender perspective, in 99% of the cases in US, the lenders want and they also get personal guarantees, irrespective of the fact whether they are even federal government backed loans, which are the SBA loans, or traditional loans, or even alternative lending. So,
Okay.
so that is an important aspect, and that's what most of the business owners should be prepared for. That if they want financing for the small business, they have to furnish a personal guarantee.
All right. Next slide. And I just want to mention again for anyone who joined late, I am actually joining you from a hotel room in Austin where I'm at a convention. The connection isn't the greatest. The lighting isn't the greatest. So that's why I've got a phone. That's why the lighting is kind of bad here, but I'm doing the best I can. And thank you for bearing with us. All right. What are the common misconceptions that you see business owners have, Rohit? We've got 4 here. I wonder if you could quickly walk through them for us.
Absolutely. I think a lot of business owners say that, I don't want to finance against my business. I can just use my own money, or I can use it for my personal credit card. So using your own money is good and bad both. It's good because it gives you that sort of peace of mind that you don't have to pay back anybody else. I think the challenge with that is that, one, you cannot keep growing your business by just putting all your own money into business. That's also not good for your financial management, because in most of the cases, business owners should learn to keep their business and personal financials separate. The second aspect is that by borrowing money, it brings more discipline in the business, because it also forces you to be more cognizant about your cash flows and paying back your debt every month, which if you're not borrowing money, you have no pressure. And then over time, you can lose a lot of your money. The second aspect there is that, by borrowing money, you also start establishing a business credit history. So business credit history is almost similar like your personal credit history. And if you borrow money on business and you're paying back on time, then your business standing goes up. So over time, you'll get more money based just on your business cash flow. And then you get a big tax write-off on all the interest payments that you make, which if you don't borrow money, you will not get back. I think the other key challenge is that a lot of business owners feel that they can either use their personal credit cards, or they can take a mortgage, or they can take what we call home equity line, on their homes, and can, fund the business. Credit cards, by doing that, short term is okay, but as soon as you borrow and you have more than 50% of your available limit already being utilized on your credit cards, your credit score will drop anywhere between 20, 30, 40, 50 points, depending on other factors. So that's not good, because you start looking a lot more leveraged on the personal side. Secondly, again, it's not going to build your business credit. And third is that it's not a sustainable strategy if you want to grow your business. By getting a home equity line, there are 2 big challenges. Now, one challenge always has been that, you're putting your personal assets online if something happens to your business. So that, I think, is risky. The second big challenge is that, home equity lines have become very tough after the recession to get, because they're typically second lien position, lines. And that's where, while the interest rates are low, getting decent amount of money is tough. And again, that doesn't help your business credit. So in long term, that's not a good strategy. And now with the new tax bills which have come, actually, this is the first time in history of America that the tax bills are catered more towards businesses and small businesses than towards individuals. So if you are, borrowing money on your home and you want to use that for business, the tax write-off that you are going to get is going to be much less compared to if you borrow money on your business and you are paying back money on your business. So I think that's very important that you have to not use your personal credit cards or your home equity lines and all that stuff. Because as soon as you use your home equity line, also it shows on your credit, personal credit. And if your utilization rate is very high on your personal credit lines, then or on the home equity line, your credit score will drop.
Okay.
Yeah. So I think that's a big, like I think that's one of the biggest misconceptions that we see out there.
Uh-huh. Let's jump to the one about there's nothing I can do about my credit score. Do you agree with that?
No. I think most of the people where I see the credit score being low is not because of the fact that they've done anything wrong or they have missed payments. Most of the time it's just over extending their credit limits. Having too many open credit or revolving credit, that's the other thing. And the third thing is that, sometimes they have small collections like medical collections, $100, $200, we see it so many times. They don't pay attention to their personal credit, like they're not, paying the bills on time. They should put auto pays on that in this day and age. They are not, or they're just overextended. Like we see a lot of people, having 2 or 3 cars, on their credit, which doesn't make any sense. You should lease a car and not, own a car. That's better because it won't show you on your credit if you're not having an auto loan. And I think the other big thing is that, don't just make minimum payments on your credit cards, because if you're just making payments and you have a lot of outstanding debt on your personal credit cards, it impacts your credit score dramatically. And so I think those are a lot of times, these are minor stuff that you can take care of. Your credit score will improve anywhere from 30, 40, 50 to even 100 points. We have seen.
Mm-hmm.
So I think very important for you to be very cognizant about what are the impacts that is going to happen.
Now, what about the last misconception listed there, that every lender will arrive at the same decision on my application? Talk to us about that. Some people do believe that. They think, well, I applied once. If I got a no, then nothing I can do.
No, I think it's a big misconception. While what we advise our customers is that don't apply in like 5 or 10 different places simultaneously, because then everybody will pull your credit. So many people pulling your credit will bring down your credit. It will also show that you are desperate for money, which is never good. But having said, there are so many different kind of lenders who are out there. There are lenders who are banks, there are lenders who are credit unions, lenders who are alternative lenders. Everybody looks at it differently, and everybody has a different risk tolerance and a risk perception. And the other thing is you have to also leverage your assets. So let's say you have a lot of AR, account receivables, or you have equipment, or you have a real estate asset. Then you need to leverage that more when you are putting out your application in order to improve your chances. And then the other thing is that you should know, before you apply, that what kind of lender you really want to go. So an example is, if you're less than 3 years in business, going to a traditional bank for money, don't even do that. You're not going to get it. You might have the best business out there. So I think knowing some of the basic rules and researching, there's a lot of information available online today. You can come on Biz2Credit.com. We have a lot of these blogs and other stuff. There's tips and tools and all that stuff which we can, where we help businesses to figure it out. And then the idea is that, always research first and always position it the right way, because most of the business owners don't even research anything, and then they don't position themselves well when they're applying for, credit out there. So I think that's very important, how you fill out an application, what story you tell, are you fully prepared when somebody comes from a site visit? That's important, because you can have the best application out there, the best credit score, and somebody comes for a site visit and finds something totally different, or they ask you a few questions, and because every time, there's an interview that will happen of the business owner, and you don't even know what business you are in, or you just gives a very vague answers, that's enough ground for most of the lenders to turn you down. So I think be more well prepared on that side. If you are well prepared, then getting access to credit is an easier value proposition than not getting access to credit.
Okay, well, and next slide, please. So I think what you're saying is that Biz2Credit, one of the things that you help small businesses do is actually position themselves properly to find the right lender and actually have the best put forward, right?
Absolutely. So that's what we do, and we do it in a way that it doesn't hurt your credit, it doesn't hurt your overall business standing. You don't have to shop around yourself. You don't have to waste your time in wondering what you're doing, what you're not doing. So I think those are some of the important aspects that we help you at Biz2Credit, and that's all free. You can pick up a phone, talk to one of our credit specialists. There's a free consultation. There are a lot of, there's free live chat. There are a lot of tools which are out there on Biz2Credit, because one of our aim is to help business owners not only get financing, but also get the right kind of financing, the right credit, and the right tools, to even use the credit, because it's also very important once you get credit of how you're using that money in the right way, because you have to pay it back. And you have to, know that, if I'm borrowing a certain amount of money, I should have the capability and affordability to even pay it back, actually.
And so talking about the right type of loan, the slide that we're looking at right now, it lists 7 main types of small business financing. Now, there are a lot of different vehicles out there for financing, but these 7 types are the ones that what really most small businesses end up getting. Is that correct?
Yes, absolutely. So these are the I'd say lion's share of the funding in the small business space. And term loans are traditionally anywhere from 2 years to 10 years. If there's no collateral, if there are SBA loans with real estate collateral, it can go up to 25 years. Line of credits are typically revolving, where there's interest-only payment. But then you have to be very careful, because they typically, banks want some cleanup. So what that means is that every year for 30 days you need to make the balance zero, because you cannot use lines of credit for long-term working capital needs. Then you should go for a term loan. Cash advances are really good for businesses like retail businesses, which accept out of credit cards, which who are more. It's easier for them to make a daily or a weekly payment than one lump sum monthly payment, and also good for businesses which get more of the cash receipts or credit card receipts than I would say. So mostly for B2C businesses, cash advances are good compared to B2B businesses. Commercial real estate loans, as the name suggests, either buying real estate or if you have a real estate, fixing it up, or you want to use that as a collateral to get working capital. Then equipment financing is self-explanatory, buying equipment, or you have a piece of equipment and you want to use that as a collateral. SBA loan are small business administration loans, which are the government guaranteed program in this country. They do around 30 billion a year, and this is one of the best programs, for getting cheap money, but it takes a lot of time, 2 to 3 months, pretty time consuming, paper intensive kind of stuff. So one needs to be prepared for that. And there are certain kind of businesses or certain instances of businesses where it's better. So like business acquisition, SBA is one of the best ways to do it. Typical working capital, SBA is not the way to go. Buying a piece of real estate which is used primarily for business, again, SBA is a good model. And then the last is the credit card. So there are a lot of companies like American Express and Chase and all these who have small business credit cards. They can extend you some lines of credit, but credit cards are basically, my recommendation is most of the small businesses should have a credit card, business credit card, to establish the business credit. But that business credit card should not become a source of a lot of funding, because that's expensive and that's also not a very smart strategy. So that's where you use your business credit cards to establish your business credit, and then go and apply for traditional term loans or lines of credit or cash advances or other forms of money out there. Thank you.
Yeah, and I like to say to people, if you're new, if you're a startup, you're relatively a young business, the easiest kind of small business credit to get is to get a business credit card. Start using it, like Rohit said, to establish credit. And then from there, you have somewhat of a credit history, as long as that credit card company actually reports to the Business Credit Bureau. They have to be one that actually reports. And if they do, then you'll be able to start establishing a record of actually making payments against business credit in the name of your business and not just you personally. All right, next slide. Okay, this is some data from Biz2Credit. Very interesting data here. So I don't know how much of a time period this covers, but this gives you an idea, doesn't it, of basically the typical types of amounts of Biz2Credit clients who are getting business funding. And, you know, you can see that merchant cash advances are actually not a huge amount, 51,000 or so. But actually, there are a lot of deals being done in that. But it looks like some of the bigger amounts are in equipment financing and commercial real estate loans, right, Rohit?
Yes. So what is happening is merchant cash advance is a product that can be dispersed at a very fast pace, and so we offer those, and especially for retail businesses which can't get money from banks. You know, that's a pretty good product. The only thing is you have to use it very carefully, like any other product. So you can't be indiscriminate, because that's a bit more expensive as a product than compared to a traditional working capital line or a commercial real estate. So one has to be careful in how to use it, but if you use the right way, it's a good product for working capital. Doesn't take a lot of time, you know, 24 to 48 hours. You know, can be paid pretty back easily, daily, weekly, or bi-weekly payments. Commercial real estate loans, you know, we do a lot of them both for buying as well as for, you know, if you have a piece of real estate and you want to fix it, or let's say you want to use it as a collateral for working capital, that can be done. Unsecured financing is, again, you know, we do quite a bit of unsecured financing, which is like really, there's still a personal guarantee, but, you know, of the business owner. But what that really means is that you can actually borrow money in a business which doesn't have hard tangible assets, so like real estate or equipment or something like that. Traditional working capital or working capital, you know, which you use for short-term financing needs. Let's say you have a account receivable which is due in 90 days to 120 days, and you need money for that period to run your payroll. Part of it is, you know, payroll financing. We're partners with Paychecks, so we finance a lot of their customers for their payroll needs and all that. Account receivable financing, again, is a very good product, you know, where that's one of the few products where you have an option in certain cases to get money without a personal guarantee. Again, you know, good for B2B businesses. Equipment financing, again, you know, a pretty big part of the, like, in terms of the average funded amount, because a lot of businesses in this economy right now, which is doing pretty well, are borrowing money to buy a new piece of equipment, or they're buying it for, you know, commercial real estate, line of credit, again, you know, a lot of demand coming in. Inventory financing and credit cards are interesting. Credit cards, we don't do much, because as I said, you know, credit cards is really good product for you to offer and use it to establish your business credit, but not really a good product if you want to grow your business, because the amount of money you get is limited and it's very expensive. So one has to be very careful. And inventory financing normally, you know, is for manufacturing businesses. And, you know, in US, you know, there are the number of manufacturing businesses in the small business space are very few compared to services businesses and and other businesses. So that's how it breaks down. And, you know, the idea there is that, you know, this just gives you a flavor of, you know, what kind of products we offer and how deep we go into the, you know, into these kind of products, and what kind of average, you know, funding size that we can handle. You know.
Okay, next slide, please. I just want to remind everyone also that we will take some questions at the end. So if you have questions, use your controls on the screen to actually ask your question. Just type it in the little box, and we'll try to get to questions at the end. All right, so now what do lenders actually look at? We know that they really want to know that you're going to repay the loan. First and foremost, that's what they want to know. Just talk quickly, because I want to make sure we have enough time to get through everything. But just quickly, you know, what are some of the things here? We've got, looks like 4 things here: past credit history, debt to income ratio, your personal income, business financials. You know, among these, what would you consider the most important, Rohit?
I would say past credit history is very important, because if you have a history of being late payments, or you have a history of defaults, a history of, you know, being, you know, not a good manager of money, that's going to create a lot of problems, so that's one. And the second problem, the biggest problem we see is business financials, because a lot of business owners want to underreport their profits. And that's not good. And I think after the new tax bill which has come, I think business owners should have no excuse to underreport their profit. A lot of them put a lot of their personal expenses into the business, which again depresses the business profit. That's not good. Personal income, lenders look at it, but that's a secondary stuff compared to business income. Business income is important. So it's personal credit, business credit, and business financials. These are the three things which are the most important things. And then after that, personal income and debt to income ratio. Obviously, if you have too much of debt, then they get nervous. But in certain cases, they're fine if you're refinancing that debt. A lot of the lenders are fine with that, because they know, okay, that you might have used the money in the past to grow your business. But I think managing your business financials, filing your taxes on time, having all your paperwork really done well, because a lot of business owners have a very difficult time in preparing their business financials for some reason. P&L, balance sheet, they don't understand it. They don't use software. They don't, they don't have, or they haven't outsourced bookkeeping, or they haven't, done anything significantly, well in trying to, prepare a business plan and then, reporting their financials. So they don't have a business plan. They don't have a budgeting. They don't have targets, and one thing that I've seen, and I started this business and I run this business, until you don't have targets, you'll never be able to go and achieve something. So I think that's something very important, that your business financials have to be really good. Not only good in terms of numbers, but also in terms of reporting. Your credit history has to be exemplary. You should not be a defaulter, especially intentionally never default on any debt. That will always come and haunt you back. And and then other things like personal income, debt to income ratio can still be taken care of. But those two or three things are the most important things.
Good. All right, next slide. Okay, these are some averages. Again, I think it's really giving you a good flavor. Let's look at the one here that your average credit rating of small business owners. These are ones that are Biz2Credit clients. So 633. So what I take away from that, Rohit, is you don't need the highest credit score, personal credit score in the world. It's important. You need a decent score, but obviously if that's the average, there are business owners who have lower credit scores that are still getting credit, as well as those with higher scores, right?
Oh yeah. So you need to have a decent credit score. Anything if you're below 600 or 620, then it's a problem. But above that, then it's just a question of good credit. What I mean by good credit is not good credit score, but good repayment history. Your credit score can still be low because you borrowed a lot of money, and part of the reason you are now trying to borrow money on the business is to repay some of those debts. That's why the average debt to income ratio looks pretty high, 69%. But that's understandable when you're coming and borrowing on business. So I think having a good score means that you're paid the back on time, you haven't defaulted, you don't have a foreclosures, you don't have bankruptcies. So those are the things which, even if your score is 700 and you are a recent bankruptcy or a recent foreclosure, you won't get money. So I think that's very important. The other thing is your revenue. Revenue is important. So the higher the revenue, decent credit score, you will get money. So I think the key message in this slide is that you don't need scores of 700 plus. There's a lot of misconception that only people who have 700 plus scores will get any access to credit. You can get access to credit at a lower score. Both SBA loans as well as traditional and non-traditional financing goes at a lower credit than traditional bank financing, where they obviously are looking for 680 to 700. But I think maintaining a good credit repayment history and good revenue is more important. And I think that's what the message of this slide is. And that I think is something that people should focus on, and people should look at it pretty closely.
Right. Okay, good. Next screen, please. All right. Well, now we're going to get to the actual steps to take to improve your credit. So there are 8 steps that have been identified. And of course, the goal is to get the money that you want and you need for your business. So next slide. Let's jump right in. All right, Rohit, so what are some actual strategies that you can use to improve your personal credit score? Just quickly walk through like a few things that you can do.
Yeah, exactly. So this is a very important time of the year, the holiday season. People spend a lot of money on credit cards. So again, I said, your revolving credit on credit cards, anytime it goes above 50%, your credit score will go down. If you're applying for too many credit cards simultaneously, your credit will get pulled. Again, don't do that. Your personal debt, keep it below 30% of your gross monthly income. Very important. Anytime it goes above 33%, your like repayment, monthly repayments on your personal debt, including mortgages, auto loans, credit card debt, and everything, it will lower your score. Because the credit model starts figuring out that you are starting to have increasing indebtedness, or you can't make your payments on time. Don't make payments after 30 days, because after 30 days, 3 things happen. One, it comes on your credit as a late payment, which is not good. It stays there for 5 years, so that again is going to hurt you for next 5 years, even if you clear those payments. The second problem becomes is the interest rates on those, balances are very high. So they can go up to 29.99 or 36%. So that adds to your debt even more. And the third thing that does is that shows that you are very careless about your managing your credit or managing your finances. So all these are like big red herrings for most of the lenders. So, and that hurts. That hurts. So why do you want to hurt yourself? And I think you can check your credit score today. Now there's so many sites available. Credit card companies are offering you free credit. Credit Karma is there. There's so much stuff available that at least check your credit. Check, there are no derogatories. Sometimes what happens is that, there's some bill came in for medical copay, or, you move to a new city, you move to a new, home, and you forgot about paying an old bill because bills were coming there. So set up auto pay, get more of your bills, or get all your bills today electronically. Don't depend on mail, because we have seen that, a lot of time that mistakes happen. And then, and then just know your credit score. You have to, because, if you're applying for financing, the first thing any lender is going to do is to check your credit. So before the lender checks your credit, you should check your own credit. And that doesn't hurt you today, because it's all soft pull.
Right. And so one other question about your personal credit score before we move to the next slide, and that is, how long does it take to start seeing some changes? If you start working on your personal credit score, I mean, I think people think it's going to take you a year or two to like move the needle, and it doesn't need to, does it?
No. So let's say you are above 50% of your card limit, you pay it down. Typically credit bureaus update your score every 5th of the month. So in next month or 2 months max, within a month it will happen. If you have late payments, that's not going to go away for 5 years. But if you still have to clear it, you will start seeing an impact in 2 or 3 months. So you need to be careful about that piece. And again, debt to income, you keep it lower. If it's above 30, bring it down within month, 2 months. Again, you can see the impact. So there are a lot of stuff where you will see impact pretty much within 30 to 60 days. And there are things like, unfortunately, like bankruptcy and all that will stay for 7 years. Foreclosure will stay for 5 years. Late payments will stay for 5 years. But obviously, the more distant they become, the less, impact it will have on your credit score. So obviously, if you're late on a payment, clear it, shut it, close it. If you have open judgments, sometimes, you have open liens from IRS and all that. Don't keep any adverse stuff on your credit report open, because until it's not closed, not only it will impact your credit, but the more it remains open, the worse it gets over time. So the best thing is to close that, pay it, close it, shut it, and let that season over time, so that the impact keeps going down every month.
Okay. Next slide, please, because I want to try to get through all these, so we'll have to keep going. let's talk just briefly about establishing a separate business entity. Why is it important to be a separate business entity, such as a limited liability company or a corporation?
So obviously, again, there are three reasons. One, obviously, it helps you to protect your personal assets and business assets. It helps you to set up a business credit, which is helpful down the line for you to get a business credit history to get business credit. And now with the new tax bill coming in, if you are a separate incorporated company, you will be taxed at a lower rate than if you are a business where the income is going through. So traditionally, a lot of business owners were not setting up a separate entity because the tax treatment was reversed, where if it was flowing through in your personal income, you could book more expenses and then you paid lower taxes. But now with the new tax bill, actually it has gone reverse. So I think more and more businesses should just incorporate themselves. And obviously incorporation is more expensive, not one time, but also you have to file separate tax returns and everything. While if you are sole prop, you can just file one tax return and get away with it. But the key thing is that it's a decision of the business owners. But in my take, as businesses get bigger, anytime you are grossing more than 300 or 400,000 a year, you should consider to become a corporate entity and then start establishing the separate identity of that corporate entity.
Absolutely. All right, next slide.
Yeah.
All right, now we're talking about your business credit record. Which are the business credit reporting bureaus? Those are separate from personal credit, and they're separate records, correct?
Yes. So it's very important that when you set up a business, you should obtain a DUNS number, because that gives you a DNB record. It's important over time. They will compile a business credit on you. Experian has also a separate credit bureau for the businesses. So again, once you apply for an EIN number, you should be there. Equifax has it, and now SBFE, which was owned by Equifax, is now owned by LexisNexis. So that has become another big, source of data. And then, get a business credit card. That's one of the best ways. If you're leasing space, lease it in the name of the business. If you are, getting any utility, get the utility bill in the name of the business. Phone bills in the name of the business. So anything that way you can set up a separate trade line, just do it on the business name. That's always better to do.
And you want to do business with vendors and creditors that actually report to the credit bureaus. Now, not every entity actually makes reports to these bureaus, do they?
No, they don't. So I think that's the important thing. When you're applying for a business credit card, or when you are applying for a phone line or for a utility, you have to ask them that question, and you have to tell them. And if they don't report, then you have the ability to report it yourself to DNB and some of the other guys, so that they can start picking up that data also. So one can do that as a business owner also.
Next slide, please. All right. We talked a little bit earlier about the reason you need accounting software. It's not because a lender is going to ask, do you have accounting software? I mean, they typically don't. But it just makes getting those reports a lot easier, doesn't it?
Absolutely. So, in this day and age, the best thing with the accounting software, what I like today, is that, it has become so easy for people to, just, have an online sync of their bank accounts. And then from there, just get all the information directly flowing into your accounting software. So you don't even have to do any more bookkeeping. So I think that's a very important thing. What it also does is that, it also keeps you, on top of your things, because the problem is that, if you don't maintain your books, you won't even know what is happening in the business. You have no idea that, how much taxes due, sales tax or corporate tax and all that. So that's important. And I think the biggest thing is that, if you don't look at your financials, you will have no idea of, whether you're actually making money or not in the business, what is your unit economics, how much money you need down the line, what will be your financial needs. And, there's a saying that, you should, be ready, like you should have umbrella when it's not raining. So the kind of stuff is that, you should, if you are scampering around when you need money to put your financials together and all that, one, it will be more time consuming, money consuming, it will delay things, and it will also force you to borrow more expensive money. So the more prepared you are, the better you will be as and when you need money. And then you can also predict whether you need money, you need financing or not, when do you need it, what kind of product you need. And just from a hygiene perspective, it's very, very good. It's like, taking vaccination, it's like, okay, you prepare your books, you close your books every month, you'll never get sick, actually, So it's similar
and I'm always shocked at how many business owners just let their finances go until like close to tax time, and you have no idea where things are.
Yeah. I see so many business owners even scampering on the last day, actually, and on last day of even the extension to go and file their tax returns, which I think is very bad, because then your accountants will make a lot of mistakes. They don't care for you, and then you will get more audits, and you will have more problems, and it's something that you can always avoid by doing things in time.
Absolutely. Next slide, please. Next slide, please.
Managing accounts receivable. Yeah, I think this is one of the most important things. I've seen so many businesses which are doing great in revenue and then still they fail because they don't keep a track of their accounting records. What that means is that they don't have any track of their account receivable. So you have to invoice fast. You have to make calls for collections, because most of the people, you will get a delayed payment if you don't follow up. It's as simple as following up. It's as simple as sending them an email, a reminder email. And then you have to have a benchmark for how long your account receivables can go. Because if you don't have a benchmark, then you won't have an idea about, when you will get the money. You won't be able to balance your books between account payables and account receivables. You will have no idea of, what kind of financing you need. And even if you need, then, for how long you need it. And that just creates tremendous amount of issues we have seen, among businesses. I've seen so many good businesses failing just because of the fact that they couldn't balance their account receivables and account payables, and especially in this day and age where you have set up auto pay for everything to go out, but there's no auto pay for money to come in. So while the money will go out in an auto pay, money never comes in auto pay. So that's where you have to follow up, and that's where you have to plan things, actually.
Yeah, I think with some strategies, if you think outside the box and think about ways that you can either automate your collections or automate the payment process for your clients, or maybe do some price strategies that are a little bit different to try to get more money up front or in bigger lump sums so you don't have to chase after it all the time. That'll make sure you have that money coming in regularly, and that actually goes a long way to solving a lot of your receivables and collections issues. All right, next slide. We're on to step 6. Increase your cash flow. What are some things you can do? Cash flow is really important, isn't it, Rohit?
Absolutely. So one thing I just touched is account payables and account receivables. You have to balance them. You have to, pay, and you have to negotiate the payment terms. In a lot of cases, you can get extended payment terms, or if you're paying promptly, then, get some discounts. It's like, it's a very famous saying, 230, 160. What that means is that, you get a 2% discount if you pay within 30 days, and you get 1% discount if you pay within 60 days. So I think it's very important. If you're paying promptly, then get discounts. If you can get extended terms, get those extended terms, without the need to pay more money or more interest on it, where that's important, but also collect money. And also, just be cognizant. So let's say, for example, a lot of businesses I see, healthcare businesses, they get money every 15 days, and, they're running their payroll on a weekly basis. So align your payroll with when you get the money. That's important. Instead of, that misalignment that happens a lot of time. And the other thing is, keep your expenses low, and plan for slow season. The one big problem I see with businesses is they never plan for a slow season, because most of the businesses have a slow season, and they and during the busy season, they get a lot of cash, then they spend it out or they do something else. And when the slow season hits them, then they're not really ready for that. So you have to be ready for that. And then the other thing is that, if you are looking to, collect your money faster, you can also give people discount. You can say, if you pay me in 30 days, again, I will give you a 1% or 2% discount, but pay me fast. So I think that's the other way you can incentivize people to pay you fast, on the other side. Yeah, so very, very important, and just keep a close eye, because the more you improve your cash flow, the more sustainable the business becomes. The business doesn't become profitable just because, you have a, cost versus sale. It also becomes profitable only when you receive money fast in your account,
Absolutely. Next slide, please.
Yeah, so this is very important. Again, we have seen people, so they will, like most of the business owners, file for tax extensions, which is fine, but they don't realize that tax extension filing doesn't mean that you can file your taxes late. That just means that you can only file your tax returns after a certain period of time. So by most of the businesses, March 15th, if they're incorporated, or if they follow a January to December year, they have to file their business taxes by March 15th. Pay your taxes quarterly if you're making profits. Never get behind on payroll taxes. That's one thing which you should never do, because that attracts a lot of pain, a lot of fines. Again, it damages your business credit history massively. People don't realize that. And then I think you should have your tax papers ready all the time. You should have it in your doc vaults, everything. Biz2Credit, like, for example, gives everybody a free doc vault, irrespective of the fact whether you have borrowed money or not from us. You can store it there. It's a 10 GB space. You can get it from your phone and from an app, online. So always have it handy. Don't depend on your accountant to get it, both personal and business. And then the other thing is that, if you have quarterly tax payments to make, then ensure that they're made on time. You should not just outsource it. While you can outsource the actual, the process to an accountant, you cannot outsource the responsibility to the accountant. So I think that's important. And then you have to manage your cash flow accordingly, because we have seen a lot of people, they collect sales tax and then they don't pay it to the government on time because they haven't managed their cash flow well. They feel, or they are not able to account for that the sales tax which is coming in is not their money. That's the money that has to go to the government. And we see a lot of retail businesses getting into trouble because of that.
Mm-hmm. Okay. Next slide.
Yeah. So I think you have to make a compelling impression. As I said earlier, you will have a site visit, you will have to, go and, look at, it's like, it's the first impression. It's like you're going on your first date. So you need to give a good impression, but that good impression also has to be the correct impression. You cannot be one thing and try to show something else. So I think that's very important. Every business in this day and age should have a website, whether it's a retail business or B2B business, anything. Because what it does is that today, the first thing an underwriter does is just look for online, what you're doing. Positive reviews are important. If there are any big negative reviews, you have to answer them back, or you have to give your reason so that somebody's looking at it, they can see it, that you have responded to it. Trademark is very important, because if you don't have a trademark, on your name, other people are using it. It just creates a lot of confusion. It makes your business look a lot weaker than what it is. And I think by investing today in social media and digital tools is very important. Any business which doesn't have a digital presence today, from a credit worthiness or from an underwriter perspective, it looks like less attractive business. It looks less, and that also has a cost, because if you are on social media and you are investing in digital, your business grows. So there's a direct correlation between using digital tools, being on social media, and how your business is going to perform. And I think the other thing is that, you should encourage positive user reviews. So there are a lot of tools available out there where you can ask your customers to leave your reviews. If there's a bad review, you can, follow up with your customer. You can you can put a response. You can encourage them to change their reviews if possible. But I think keep a check on your reviews online is very, very important, in this day and age. Yeah. So I think those are some of the key things that you need to do, besides, having your financials in place and your credit score being fine, and you don't show, and you should not have a lot of debt and all that kind of stuff. Yeah.
Exactly. Okay. Next slide.
I think we can go on the next one. Yeah. So I think what we do here is quickly is that we provide you with a free BizAnalyzer tool, which is available on Small Biz Trends also. You can go there, you can come on Biz2Credit. You know what it does is it gives you a free health checkup. It helps you to benchmark your business against other businesses. It helps you to map your cash flow. It helps you to take your business to the next level. And that's something important, and you can try it. And it doesn't impact your credit. It doesn't impact your business credit. It just enhances it. It's available through an app. You can use an app. You can do a lot of stuff now, you know, online and through these tools. You know. Next, go to next slide. Yeah. So this is just an example of how the tool looks. The analysis is there, and also, you know, you get a full report. You can subscribe for a report. You will get it in an email also, and you can take it from there. Okay. Yeah. So the recommendations are also available in that, so you can, you know, look at all the recommendations also, you know, while doing that. Yeah. Next slide. Yeah. So I think any of the customers who want a consultation, they can, or any of the webinar attendees, you know, they can go on info@biz2credit.com. They can call our toll-free number 800-200-5678. You know, they can reach out through Small Biz Trends. You know, we have a nice, page out there. A lot of articles, a lot of content on Small Biz Trends also. And, you know, one of the Biz2Credit funding specialists can help you.
Okay. Actually, I seem to have lost the video connection, so keep going, Rohit. Thank you.
Okay. Yeah, so I think that's where we are, and, you know, we have a lot of these discussions. If there are any questions, or, you know, Anita, if you see any questions, because we're almost at the end of the hour also, you know.
Yes, we have unfortunately run out of time, but I hope that this was filled enough with information that you got most of your questions answered. And we will be providing an ebook that has a lot of this information in more depth that you can read. And we'll be providing this in the next couple of business days. So everyone who registered will receive that. Also, I did want to mention that we're going to pick out some people for personalized consultations if you would like one, and 3 people, up to 3 business owners, and you get personalized consultation for your credit and suggestions from someone from Biz2Credit. As you can tell from listening to Rohit, they certainly are experts in this. They live, eat, breathe, sleep small business loans and financing of all types, and they definitely know their stuff. And I'm sure that'll be a very interesting experience, won't it, Rohit?
Yes, absolutely. I think it will be our pleasure and privilege to help any of the small business owners, you know.
Absolutely. Well, with that, I am afraid we are at the end of the hour. So are there any final words you'd like to add, Rohit, before we sign off?
Yeah, I think the final words is that, I think like somebody just asked a question that they are not a business owner, can they still get a loan? I think first you have to be a business owner to get any kind of business financing. But I think the key thing is that if you're looking to open a business, or you have already opened up a business, then, you know, you should start thinking about building a business credit, think about, you know, getting access to credit down the line, because that's the only way you'll be able to grow. So I think that's what we have to say. And then, you know, we're always there. You can come on our website, you can call our toll-free number, you can go on live chat, and we can help you, you know.
Absolutely. And that's biz2credit.com. Of course, we'll send you the information for the ebook itself, but please go visit biz2credit.com for any of your funding needs, or just to get information and learn about it, or learn more about how to improve your credit and your chances of getting the money you need for your business. Well, with that, I want to thank everyone, and that concludes today's webinar.
Thank you.
Thank you, everyone. Goodbye now.